Okay, ready and action. Okay. We are here to talk about one of our favorite topics, which is capital gains. And specifically, we're going to talk about the IRS Section 121 exclusion, which gives you up to $250,000 or $500,000 deduction off the capital gains on your house. There's still a lot of confusion as to how capital gains works in real estate. Even as recently as a week ago, we had a discussion with a potential client who still thought the rules were as they were back in the 90s and there before. So we thought it would be great to sort of take a deep dive into how the capital gains works, specifically on the sale of a primary residence. But it's really the same as if you sell an investment property, but then you don't get the exclusion, although there are some other avenues then that can be explored. So let's get into it. Let's talk about capital gains. So first of all, what are capital gains? Well, in its most simplistic form, if you make money, you have a gain, right? So just like ordinary income, if you work a couple hours, you get paid by the hour, you obviously make money, that's income. For most people, that is taxable, depending on your brackets, the amount you make, et cetera, et cetera. Well, capital gains works much the same way. So the federal government views it as if you buy something for $100 and then you sell it for $150. Well, you've made $50. And maybe that's how things work if you're trading I don't even know what's that much money anymore, a trading card or something like that. But when we talk about real estate, we're obviously talking about a whole lot more money. So if you buy a house for $900,000 and a few years later you sell it for $1.5 million, well, you've made $600,000. And in the market we're fortunate enough to be in, sort of Newport Beach, Costa Mesa, Newport Coast, areas like that. But you can obviously imagine this in a lot of areas throughout the country. You have someone that maybe bought a house for $2 or $3 million. And then, years and years down the road, now it's worth $7 or $8 million. So we routinely deal with people who have enormous potential capital gains. In fact, one client not that long ago, down on the Newport Beach waterfront, they had bought the house for $30,000 back in the 50s, and now it's worth over $8 million. So literally an $8 million gain that then we start talking about how the capital gains works, and it very quickly becomes an impediment to selling houses, as we've seen, and that's part of the cycle of problems, one of the many problems with our tight real estate market, because people are simply not selling. They don't want to pay those capital gains. Therefore, there's less inventory. Therefore, the prices of other existing properties go up, and it's just one of the many things that's kind of driving this cycle of causing prices to be higher and higher and higher. So we've talked about what a gain is. Well, I think one of the most important things to realize is that the taxes, when it comes to the sale of real estate, changed in 1997. And we've encountered, as I mentioned, even as early as last week, we've definitely encountered clients that maybe haven't sold a home since 1997, maybe haven't sold a home ever, and are looking at old articles or talking to their parents about how it worked back in the day. The rules changed in 1997. It used to be that you could sell your primary residence and then essentially buy a new primary residence and not have to pay any capital gains taxes, as long as you basically rolled it from one property to another. Now, there is another rule in investment properties called the 1031 exchange that maybe we'll talk about, or we have other articles on, where that still does apply, a lot of different rules and factors there. But when we're talking about your primary residence, so the home that you live in, or even a vacation home or a second home, that rule has been dead for, over 25 years, right? 1997, the rules changed. So literally, you have to pay taxes now on the sale of the home, subject to this IRS 121 exemption that we'll get into in a second. So if you sell your home, you're going to pay taxes on the gain. It doesn't matter if you're buying another primary residence. It doesn't matter if you're taking the money and putting it in the stock market, or you're going to Las Vegas and putting it all on black. It doesn't matter. You're going to get taxed on the amount of the gain, subject to some of the exclusions that we'll talk about. So that old rule that was in effect back in 1997 and prior, where you could buy another property and just simply roll it over and not have to pay a gain, is no longer the case. So what did they replace it with? So in 1997, they came up with this new rule, the IRS 121 exclusion. And basically, it simply says that if it's your primary residence and if you're single, we're going to give you up to a $250,000 exclusion. And if you're married filing jointly, we're going to give you up to a $500,000 exclusion. And quite simply, that kind of is exactly what it says, right? So if you are married and you bought a home for $500,000 and then you sell it for $1 million, well, you've made $500,000 in capital gains. But because it was your primary residence, because you're married filing jointly, we're going to give you a $500,000 exemption. And in that particular case, with that particular couple, they're therefore going to pay no capital gains whatsoever, because that $500,000 is the exact amount of the gain. If it was a single filer, you'd only get $250,000. So if a single person bought a house for $500,000 and then later sold it for $1 million, they've got that $500,000 gain. They're only going to get a $250,000 exclusion in that instance, and therefore they're going to have $250,000 in capital gains. We'll talk about some of the other tests here in a second. But now go back to that story I told you about where the person had over $8 million in capital gains. Well, it's great. They get a $500,000 exclusion because they do happen to be married and meet the other requirements. But now they're still looking at $7.5 million in capital gains. That $500,000 is not really enough to necessarily move the needle to push them into the desire to sell a property versus not sell. And therein, highlights the problem. People aren't selling. Okay, boohoo, $8 million, but extrapolate that to a lot of ordinary houses that we have here in Orange County and California. People have $1 million houses, and that doesn't mean they're millionaires, but they happen to buy the houses 10, 20, 30 years ago for a few $100,000, and all of these people have enormous gains now. And that rule prior to 1997 no longer exists. And so, like I said, even to this day, we have these conversations. People think, oh, well, I'm just going to buy another primary residence. And we tell them, no, you're still going to pay taxes on that. And it ends up being a pretty big deal. Fun fact, that $250,000, if you're single, $500,000 if you're married filing jointly, that has not been adjusted for inflation since 1997. Lots of other things lots of other indexes that we work with in real estate and taxes, they get adjusted for inflation. But for whatever reason, the powers that be, they, I guess, deliberately decided not to adjust that. And certainly taxes are a bit of a hot potato, even when we've had some positive tax reform, or, depending on your political philosophy there, we've had some tax reform that have made things so that people pay less taxes. They still have not adjusted that number. And you could certainly understand politically why, because someone in the Midwest that maybe they bought a home for $100,000 and now it's worth $150,000, obviously these exclusions are going to be more than sufficient. But when you look at these markets where we have enormous gains in the property value and enormously high cost of living, such as Southern California, we have in a lot of parts of California, that $500,000, it's just simply not enough. But there just simply hasn't been the political desire to adjust that. So if you do want that number adjusted, you should probably get on the phone with your congressperson or senator and let them know about that, because it is, quite frankly, keeping people in their homes, which is, again, increasing the problem. So let's talk about how you even get this $250,000 and $500,000, because it's not guaranteed. It's not just simply having it as your primary residence. There's a two-part test, and the first part is the ownership test, and the second part is the use and residency test. So quite simply, you have to have owned the property and used it as your primary residence for 2 of the prior 5 years. Well, what does that mean? There's lots of asterisks and everything, right? So if you bought the house 10 years ago and you've lived in it as your primary house for 10 years, no problem, right? There's no question. It's your primary residence. You're getting the full amount. If you bought the property only a year ago, and even if you're using it as your primary residence, too bad. You have to have owned it and had it as the primary residence for 2 years. So that's a pretty clear-cut case, right? You've owned it for a year and a half. You're not going to get any of the benefit. Wait 6 more months until you sell your house, right? You've owned it for 6 months. You got to wait a lot longer. Where the gray area starts to really exist is when people, maybe they've owned it for 10 years, but it was a rental the last 2 years. Well, in that example, you still qualify because remember, it just has to have been your primary residence for 2 out of the last 5 years. So if you kind of reverse engineer that and do the math, it means you can basically have it as a rental for up to 3 years prior to the sale. Obviously, you have to be very careful about that date and make sure it works out. But if you lived in it for 2 years and then rented it for 2.5 years, you're fine because you've still used it as your primary residence for at least 2 years out of the last 5. And you can see how you can get very creative with these examples. But obviously, if you've rented it for more than the prior 3 years, then you're going to be in trouble. So if you come to us and you say, hey, it was my primary residence for 20 years, but I've rented it out the last 3.5 years to a tenant, you're completely out of luck. Because then if we look back at the last 5 years, you only have 1.5 years of personal residency and the 3.5 years of the tenancy. So in that situation, you would be out of luck. You'd need to move back in, get that additional 6 months, assuming you can still kind of bookend it in the time frame. Because remember, you only have that trail of 5 years, right? So it doesn't matter what you did 10, 20 years ago with the property. All that matters is how it was used the last 5 years. So that is the situation that we do find people are in, where they've simply rented it for too long and they're out of luck. So that's pretty easy on the residency. There are several exceptions. Service members, for example, so if you're in the military, intelligence, Peace Corps, maybe you work for the State Department, maybe you're a spy, whatever it is, there are exceptions, though I guess if you're a spy, you're not necessarily reporting this to the IRS, but there are exceptions for certain types of employments, military service, obviously being the most obvious there, where then you do get additional time. Death of a spouse, a separation or a divorce, properties that were destroyed or condemned. There are some pretty decent exceptions to the rules. So, if you have a unique situation, reach out to your tax professional, or there's an IRS publication 523, which goes into detail about some of those other exceptions. But just because, I was sick, I didn't feel like selling it, or I was going to pay too many taxes, or, it wasn't on my radar, none of that's going to fly. These have to be legitimate exceptions to some of these rules that you can look into. But otherwise, the use residency, it's usually pretty straightforward, but there are people that have some very, very creative issues, usually involves having had it rented. One thing that comes up a lot is, well, what if you're married? What if you just got married? Well, that's kind of a fun one. So let's say, for example, you own the property for the last 10 years, used it as your primary residence, but you just got married a year ago. Now, do you get the full $500,000 or do you only get the $250,000? Well, each spouse has to meet the residency requirement, but not necessarily the ownership requirement. So in other words, your spouse has to have lived there for the last 2 years in order to get that full $500,000, but doesn't necessarily have to be an owner. So that's a pretty limited exception, but you can envision a situation. Here's a pretty easy situation. We were unmarried, lived with your girlfriend or fiance for the last 3 or 4 years, but you only got married a year ago. Well, in that case, now you're going to get the full $500,000, because even though you've only, well, I guess we're assuming about the title, only the title doesn't matter in the marriage situation, right? It's just the residency. So when it comes to marriage, all you have to worry about is the residency. So one spouse can be the owner, but you still both have to meet the residency requirements. So that is something that does come up a lot, where maybe someone owned a home for a very long time, they just got remarried, a year, 2 years ago, or the spouse just moved in a year ago. It's not going to be enough. You're going to have to wait that full 2 years. But you don't have to put the spouse on title, which is sort of a common misconception. So we've seen that. People come in and say, I've got to have my spouse on title for 2 years. No. So if you've lived, you were unmarried, or heck, even married, and you've just lived there for 5-10 years, but you just never added your spouse to the title, that's fine. So that's sort of one of the things that we see come up with a lot. Okay, so that's pretty much it. The ownership test and the use test. You got to have both. So to recap, quite simple. You got to have owned it and used it as your primary residence for at least 2 of the prior 5 years. And then you get the $250,000 if you're single, $500,000 married filing jointly. Let's talk about capital gains in general, and let's kind of go back to that. So we obviously talked about any of the profit from the sale is what's going to, be taxed upon. We gave some examples to that. Let's talk about the current rates. So these sort of change every year. We've been keeping track of this for several years, and they've gone up a little bit. There were some significant changes a while ago, and these, unlike that exclusion amount, these sort of have been automatically set to escalate. Now, interestingly, the numbers that we're about to go over, I'm sorry, these numbers. Some of the other things when we get into estate taxes and stuff are actually going to sunset in 2025 at the end of the year here. But these capital gains rates, so this is for 2025. So if you're single, the rate is anything up to $48,350 is zero. So if you just make, $20,000 on the sale of your home, there's going to be no capital gains anyway, whether or not you'd apply for one of these exclusions or not, nothing. Anything between $48,351, $500, $33,400, you're in the 15% federal rate. Anything over $533,400, you're in the 20% federal rate. We'll talk about states in a second. So that's the single filers. So if you're married filing jointly, the numbers are bigger, but they're not necessarily double. You do get up to $96,700 at that zero amount. So that kind of roughly is nearly double. So again, if you're a married couple filing jointly, you make $90,000 on the sale of your house. Well, no capital gains due just as that. Now, if you have other capital gains, something that add on to that, you might. But if it's just that home, you're not going to have any federal taxes due because you're under that threshold. $96,701 all the way up to $600,000 is the 15% rate. And then over $600,050, you're in the 20% rate. So $600,000 is a pretty decent amount, right? So again, if you're selling that house and you've got the $7 or $8 million capital gains, you're clearly going to be in that 20% bracket. And let's talk about how this works in a second here. First of all, one of the other things we've got to keep in mind is that if your modified adjusted gross income is over $200,000 for individuals or over $500,000 for a married couple, you're going to get an additional 3.8% tax, which is part of the Affordable Care Act, or the AKA Obamacare Act. So going back to those numbers, you could certainly be in a position where maybe you're only in a 15% federal rate, or you're bumped all the way up to 20%. But if you're over 200 for individual or 250 for the married couple, you're going to have an additional 3.8%. So those numbers really then go up to 18.8% and 23.8% respectively. So that's kind of a big deal, and a lot of people sort of forget about that. Then your state tax, right? So a lot of states have taxes, not all. If you're unfortunate or fortunate enough to live in the state of California, we're in one of the highest tax brackets, and that can go all the way up to 14.4% for over $1 million. Now, interestingly, in California, we don't really deal with capital gains. California says, I don't care how you make your money. They're just going to treat it all as ordinary income. So those brackets that we talked about earlier, those are the federal brackets. When you go to pay your California state taxes, it's totally different. So if you have that $600,000 gain from the sale of a property, let's say you make $500,000 from other ordinary income or other sources, you're now making $1.1 million per year. California is just going to look at that at a whole and then tax you based on that. So remember, if you're over $1 million, you're in that highest bracket of 14.4%. Obviously, going back to that Newport Beach house where they're making the $8 million profit, they're going to be in the highest federal tax at 20%. They're certainly going to get that extra 3.8% Obamacare tax. And now they're going to be in the 14.4% California bracket. And that number is significant. So high earners in California, you can expect all the way up to 38.2%. That's a significant number. So 38.2%. That's well over a third of the amount. You can see how that's a big number. Now, other states treat capital gains differently. Some might not even have any income tax at all. So, versus a California resident, you're saving that 14.4%, which is obviously very significant, right? Going back to those federal numbers, so fun fact is that the IRS capital gain rates, they're based on your total income for the year, but you only pay taxes on the capital gains. So what do I mean by that? So we talked about those exclusion numbers, right? Let's stick to the married filing jointly for a second. And over $600,000, $50 was that 20% number. So let's say, for example, you made $500,000 on the sale of your home, right? So let's use that nice, easy example. You bought it for $500,000, 10 years ago. Whenever it was, you sold it yesterday for $1 million. So, you've made $500,000. But let's say you and your spouse combined to make an extra $200,000 a year in ordinary income. Well, your total income for that year now is $700,000. That's the number that the IRS is going to use to pick your rate. So even though your capital gain was in the 15% bracket, because your overall income is in that 20% bracket, you're going to pay 20% on the capital gain. And now take that back to some of those other earlier examples. So, even if you only make, $100,000 on the sale of the property, in and of itself, that shouldn't be subject to capital gains. But you make $800,000 in some other ordinary income, well, now you're in that higher bracket, and therefore you're going to get taxed on the gain. So that's also sometimes a very confusing situation that people find themselves in, because even some people, we deal with people who, again, make enormous gain just because they've owned the property for so long, but, maybe they only make 30, 40, 50, 60 grand a year, or they're on some sort of fixed income or Social Security or whatever it is, that can still sometimes be enough to sort of push them into other brackets. So that is unfortunate. They definitely look at it at a whole. So important thing to keep in mind. Total income. We talked about the state of California, so all of their different brackets, and again, that's a significant high bracket. And again, why you see just some people just not selling their houses. So let's talk about some of the other things that you can use or that'll go into this capital gains rate. To figure out the actual profit. So people all the time say, well, what else can I include? Hey, I've done capital improvements over the years, so everyone kind of hears about that. So typically speaking, a lot of your expenses and your capital improvements are also going to be not taxed, essentially, right? Or you take that off the gain. So let's give an easy example, and then we'll get into some of the specifics. If you, for example, bought that property for $500,000, you sold it for $1 million. So we talked about in theory, now you've got that $500,000 gain. But let's say you had $50,000 worth of closing cost in that. So you've got maybe some realtor fees, you've got some escrow fees, title fees, maybe there's a county tax, transfer tax, all sorts of other fees that are easily going to start to add up. Well, so that example of the $50,000, you take that right off the top. So now instead of having a $500,000 gain, we've only got a $450,000 gain. So that's sort of the easy low-hanging fruit. Any of those closing costs are going to be able to be deducted. But improvements as well. So using that same example, let's say they did a $100,000 kitchen remodel a couple years ago. Well, we're going to be able to deduct that now. So now we're going back to that. They've got a $500,000 gain, but they've got $50,000 in closing costs. So we'll go down to $450,000. Now we also get to take that $100,000 remodel and deduct that. So now we're all the way down to $350,000. So you can see how those improvements can be a really big deal. And obviously sometimes, especially some of these higher end properties, people do, $200,000, $300,000, $400,000, $500,000 improvements. Maybe you do an addition. I mean, we've had people do, 7-figure remodel jobs or additions to properties. So all of that really can add up. Some of the examples that the IRS absolutely does count as an improvement would be an addition, such as a new bedroom or an add-on to a bathroom, a deck, a garage, a porch, a patio. Any sort of actual addition where you're adding square foot or adding to the structure, that's definitely going to be counted. A lot of landscaping can get counted. So lawn and grounds, landscaping, hardscaping, maybe you put in a new driveway, a walkway, a fence, retaining wall, swimming pool. You do a giant backyard remodel, you add a swimming pool, a built-in barbecue, all those sorts of things are going to be able to count as improvements. Systems such as heating systems, central air conditioning, HVAC, furnace ductwork, central humidifier, central vacuum, air water filtration systems, wiring, security systems, lawn sprinkler systems, all those things count towards the deduction that you're going to get. Exterior work, they specifically call out storm window, doors, new roof, new siding. Things such as installation in the attic, walls, floors, pipe, ductwork, plumbing such as a septic system, water heater, soft water systems, filtration systems, interior work such as built-in appliances, kitchen modernization, flooring, wall-to-wall carpeting, and fireplace are some of the items specifically called out. But many things do not qualify. So generally speaking, they don't want to see repairs, or you cannot include repairs. So if you had to repair a furnace for, let's say $500 repair job, that is not going to count. But if you replace the furnace, and let's say you spend $1,000, $2,000, $5,000, whatever it is to replace the furnace, that will count. So there's definitely a distinction between the repairs and the improvements. So repairs do not count. Improvements do count. Now, there is a whole IRS publication, Publication 523, that goes into a lot of detail on all of this, some of the exclusions to the 121 thing that we talked about, as well as some of these improvements that either can or cannot count. Some other examples of things that do count. We talked about this. We talked about the commissions, legal fees. Maybe you've got an attorney involved in the process as well. That's certainly a service we provide and common on the East Coast. There's a lot of additional things that can count. Charges for the utilities. We talked about legal fees, survey fees, transfer fees, title, taxes. All of these things can definitely get included. And we talked about, just generally speaking, not including the repairs. Let's talk about any other magical solutions to avoid capital gains. Well, unfortunately, those are really the big ones, right? Going back to your improvements. Oh, one of the things that comes up all the time, in fact, we just had some clients, we helped sell a house here in Costa Mesa. They had owned the house literally over 50 years. And this question comes up all the time. How on earth do I go back and figure out all my improvements that I've done over 50 years? Well, that's a tough one. So for any new homeowners out there, certainly start keeping a list, get a little spreadsheet, a Google Doc, whatever you use, and start trying to keep track of it. But gosh, you sell a house and you're trying to look back and recreate 50 years worth of expenses. That's going to be challenging. There's no hard set rule about the documentation. You don't necessarily have to have a receipt per se. But, how do you prove or disprove an improvement? So, we tell clients, obviously, try to look through boxes of receipts, try to find out what you have. But ultimately, sometimes you just don't have that information. Maybe you go back through family photos and try to see, remember the house, here's a photo of us in the 1970s with the old kitchen, and, now we're staring at a brand new kitchen. So we know, obviously, at some point in time, we did a giant kitchen remodel. Maybe we can go down to the city, search for some building permits, things like that might give us a clue. It can be challenging, but the burden is, sort of on you, the taxpayer, to figure out that number. And then obviously if you get audited, then you're going to have to, substantiate that. And obviously receipts, invoices, things like that are the gold standard. Certainly if you did a giant remodel last year, we would expect you to have that. But, if you say, hey, back in the 70s, I did an entire kitchen remodel, it's perfectly logical that you might not have receipts for that. But you're definitely going to need something, right? Some way to substantiate the work that was done and the amount that you're claiming for it. So I wish there was a better magical answer to that. If you are aware of one, please feel free to leave it in the comments or let let us know, because that issue does come up a lot. So the best thing we can do really is tell people, obviously, if you're preparing to sell your house, start thinking about that. You don't necessarily have to come up with these lists or the amount until you actually file your taxes. But, if you're preparing to sell your house, and especially if you're analyzing what your taxable event is going to be, that's something that you need to start looking into. So going back, how do you avoid capital gains? Well, you've got potentially the IRS, the Section 121, the 250 or the 500,000. You've got any sort of improvements. You've got any sort of closing cost. But that's really it. Sometimes people can get creative. There's installment sales you could do. If you're selling to a buyer and potentially get them to pay you over time. It doesn't avoid the tax, but then you can pay the tax along with the amount of money that you're getting each year. So we've seen some people sort of strategically look into that, but that's not really an option for most people. They want to get paid, or they have to pay off a loan or things like that. There are some interesting creative things with Delaware Statutory Trust. We talked about sort of the 1031. So these are all sort of bigger other topics that we can get into in other episodes. And we do have some articles and videos, especially on the 1031 exchange. But for most people, this is it. You're going to sell your primary residence, and especially if you're in some of our markets, you're going to potentially have an enormous capital gain. And literally that is keeping some people from selling their houses. Even with Prop 19, which we have lots of articles and videos on, you might be able to roll over your property tax assessment. So you bought that house for $30,000, in the 1950s. You've got a nice low property tax bill. You can take that nice low property tax bill and take it to a new property. And we can talk a lot more in depth about that. But that doesn't do anything for the capital gains. And that's just a lot of the misconception out there. Unfortunately, people are excited about, I can roll over my property tax basis, or, some sort of other benefits like that. But then they realize, wait a minute, but I'm going to pay 38% or whatever it is, in capital gains, and that becomes a big problem. So I think that is pretty much our summary of the day for capital gains, what it is, as well as understanding that IRS Section 121 exemption. If you have additional questions, please feel free to reach out to our office. We do strategize this. If you're looking to buy or sell a home in the Newport Beach or Costa Mesa areas or some of the surrounding communities, that's obviously what we do. And we'd love to talk to you about that and help sort of strategize that for you. If you're in other areas, we definitely do paid consultations. A lot of people do seek us out. They just sort of want some informal legal advice or tax advice, or maybe you're already working with another realtor or agent. You just want a second opinion. So we do a lot of that. So you can head over to our website and book a consultation. That's lucasrealestate.com. Lucas is LUCAS -real, REAL -estate, ESTATE.com. You can give us a call, 949-478-1623, and you can follow our various social media channels where you can find informative articles, videos, blogs, podcasts, all this good stuff for additional information. And that's it for now. Thank you for joining us.